Hello, Greg Kuda.
Hey, Mike, how are you?
I'm doing well. And yourself?
I am doing well. And
Uh,
nervously anticipating the game five today between the Guardians and Indians. So
all
let's.
right. I wish I could say that I've paid any attention to that,
That's all right.
but I haven't. What is going on?
So we
Guardians?
are game five. Whomever wins tonight advances to the American League Championship Series against the Astros. So
Okay. And then whoever wins that goes to the World Series.
yeah. So then you've got the Phillies playing the Padres in the National League right now, or that's going to
Oh,
start.
they're already to the championship series in the national side?
Yeah, they'll start. I think it starts. The ALCS starts tomorrow. I think the NLCS starts tomorrow as well, but don't quote me on the NL.
All right, cool. I need you to share your screen so we can
Let
get
me
the
do that.
presentation up. All right. There we go. Welcome, everyone. It is another rendition of Lumber Futures from the Free Seats. I'm kind of mad we haven't counted how many we've done.
I was, thinking about that a couple of weeks ago, where it's been over a year now, right? And we've been pretty consistent. Where I think we've only missed maybe a week or two collectively.
Yeah, it's been great. Um, so in the chat, let us know where you're from. Ask us any questions. Um, if you're having any difficulties getting connected, let us know. There's all kinds of options. We're on YouTube, we're on LinkedIn, of course, YouTube, Twitter, and also Twitch. Which, believe it or not, Twitch is probably the easiest one to watch the show from. So, with that, uh, let's kick this thing off. Another interesting week in lumber.
Yeah. It's not publicly announced, so I'm not going to say the company, but a very large BC producer basically is telling A-list customers that they're going to take further curtailments in BC with the exception of their largest sawmill. Kind of the word on the street is that it's going to amount to an additional 68 million board feet. So I think that explains the rally we saw in futures yesterday. Kind of the analysis of the actual numbers is kind of blah. So we couldn't even, to put it into perspective today, yesterday we spiked above the 9-day moving average. And, I'll just, before we jump into everything, I'll just pull up a chart here.
So I just did the quick math. 68 million board feet
Yeah,
is
it's about
600,
600. Yeah.
600 rail cars, just over 600.
Yeah, and again, this is not in writing, so there's no mention of who the sawmill is. But multiple confirmations from A-list customers, and I'll leave it at that. But you can see yesterday we spiked up to 520.40. The Bollinger Band highs of 510.90. You closed yesterday at 509.60, so could not close above the Bollinger Band high. And today, that Bollinger Band highs moved up to 519. Of interest, of note, we're having an inside day so far where we couldn't even take out yesterday's high on the open. So today's high is 517.80. So, ideally, if you're going to project higher numbers here, you'll break out above the Bollinger Band high. You'll close above yesterday's high of 2040, and then that sets up a bigger rally where 62% is in this 540 to 560 area. That's also the 100-day moving average, this downsloping black line. So that would be your upside breakout objective. Failure to do that literally just kind of leaves this thing going sideways, where I'm a big 9-day moving average guy. The 9 days 481. So as long as you stay above the 9-day, it kind of keeps that upside potential in play. A close back under the 9-day just reopens up the downside again in this market.
On the open, I saw some pretty heavy call selling going on, aggressive call seller,
Yeah. Yep.
um, which I mean that's a short hedge. If you're selling the calls, you have exposure to the upside, so you just think that the market is maybe topped out.
Yeah. And
Um,
here's the November call action, and you can see. Let's see what actually traded today. So you can see the 520 calls traded, the 525s traded. Looks like the 540s traded, 580s traded. Um,
the 500s too, right?
yeah, yeah, 500s. Yeah, I'm sorry, 500s too. Yep. So you drag this out, and we'll.
Actually, the 485s and the 490s as well.
Yeah, 485. Yeah, I'm looking 485 and 490s. Yep. So it's a good way to get long or short without, depending on what you're looking to do. If I'm selling those calls, I'm more than happy to collect the money. You've got 13 days to expiration, again, last business day of this month. And if I'm buying these calls, again, it's a good way to capture the upside without having the outright exposure of just buying futures.
All right, you've limited you limited your risk to whatever you paid for the call.
Yep. So there's a lot to run through. We'll start big, work down. I think the big change week over week is that equities, again, are trying to bottom out. We flushed last week down to the 3505 area in the S&P. You then rallied back up. You had a pretty dramatic move on Thursday, gave a big chunk of it back on Friday. But you can make the case that you're trying to, especially from an Elliott wave standpoint, and I'll show a chart in a second, that you're trying to bottom. The other big thing that jumps out here is crude. We know we had this big rally in crude with the OPEC announcement. Red line is crude here, by the way. And now you're at this 62% retracement. So crude should hold in this range and get a bounce back to the upside. Failure here just sets up for a revisit of that 70, kind of $80 to $75 area in front month crude. So let's jump here. So here's S&P. Elliott Wave, multiple Elliott Wave guys that I subscribe to are looking for some kind of a bottom here with the bounce back. This is on a weekly basis, so the bounce back would take you back into the 38 to 40 area on the S&P. The time frame would be into end of this month, into the middle of November, into U.S. Thanksgiving, basically. But some of the other big guys that I look at are looking at this more again as a dead cat bounce with the real low still ahead of us into the end of this year, potentially into Q1 of next year, for what that's worth.
It seems like and I've been talking about the currency exchange rates, but it seems like England is the tail wagging the dog on this one. Whatever
Yeah.
they do or don't do has really driven market action.
Yeah, I mean, they fired their finance minister and kind of rescinded all these tax things that they were going to do, and the market kind of like that. Let me get rid of this call here. Yeah, no, I mean, everybody's fixated on obviously, especially when, and we'll kind of look at commodities, but I think the demand component right now globally is weighing more heavily on the supply issues or potential supply issues out there. And the one thing I wanted to show, I thought this was a great chart here. I don't know how well people can see this, but the blue line is this year. And so this is Bloomberg Global Aggregate Bond Fund. And you can see year to date, and this was as of the end of last week or middle of last week, the aggregate bond fund was down 21% year to date. So it's giving equally horrifically bad annualized returns here year to date. And, well, how could this be? Rates are moving higher. So, you just kind of Treasury's 101, as rates move higher, bond prices move inversely lower. So if you buy this bond, there are people that locked into bonds at 1%, 2%, at 3%. depending on the yield, depending on the duration, maturity level. So as rates reset higher, that's great if you're buying the bond on that day to yield that return. But when you're buying bonds at all-time low yields, bond prices move inversely of yields. So you just got annihilated if you would have bought bonds at the beginning of this year and watched interest rates kind of reset higher here. Those bond prices have gotten hammered along with equity prices. So,
Well, what you wanted to do was take everything you had in euros and
yeah, right.
move it over to dollars, and then just sit on the cash until now. And then if you were buying bonds now, you'd be reaping a much higher yield.
Yeah, and so that's where, like, look, if you've got X amount of dollars sitting in the bank right now, and you're realistically not going to touch that money, but don't want to invest it, go buy a 2-year treasury. It's yielding 4%, and there's not a lot of you'd be happy to make 4% now over the next 2 years, or look at a 1-year treasury. It's right around that 4% area as well.
Yeah, that's the amazing thing is the yield curve is inverted. So the shorter time frame you loan your money out, the higher yield you get.
Yeah, absolutely. Yep. So the other thing that I'm a huge Mohammed fan.
I was just
He's
gonna
the
talk
ex-head
about
of PIMCO, and Bloomberg. So Bloomberg did the probability model based upon 13 indicators. It points to 100% probability of a recession starting in the next 12 months. And again, this is less based upon opinion. This is all based upon metrics, historical metrics that they watch to calculate recession actuality versus probability. And then, Goldman hit it out of the park this morning with their earnings, but their CEO came out and said that he foresees a recession as well. So you're getting all the big banks, J.P. Morgan, Bank of America, Goldman Sachs. Their earnings are good, but guess who sees the pulse of the economy through banking that touches both commercial and consumer? They have a pretty good insight on what lies ahead here for the economy over the next 6 to 12 months.
All right, but the thing I always look at is this is a known, and everybody's talking about it. It's not so much of a black swan event.
No, absolutely. And so, Mike, I completely agree. And I'll make the comment again that for a huge swath of this country that can least afford it, they've been in a recession for the last 3+ months.
Sure. Yep.
So kind of dollars kind of stabilized here for the time being.
At a high level.
Yeah, at a high level, but you've stopped surging higher. So, you're still kind of at this high level, but you're not getting, you can kind of just see how commodities in general are stumbling around right now. They're, equities are up hard today, up hard yesterday, but the dollar staying, not giving back these big gains is kind of keeping pressure on global commodities where, you're not getting the benefit of higher equity market yesterday and today being reflected in higher commodity prices. So again, I think that just goes to show that commodities right now are more fixated on global demand and fixated on a high US dollar more than anything else. And so the winners, losers, I did a 1 month this is all from bar chart, by the way, anybody can look this up. 1 month winners, volatility, heating oil. The other obvious ones, here's our lumber up 2.5% for the month. US dollar is still up. RBOB gas is still up. Wheat. And then when you look at the losers, obviously VIX is higher. So S&P is here to the downside. The other obvious ones, copper. You see all the other foreign currencies. You see the NASDAQ. Again, treasuries go higher, bond prices go lower. So you see this reflected in the 10-year, in the 30-year. And then the other big one is natural gas, which is a good thing.
I was reading about natural gas. So there's a backup of liquefied natural gas tankers off the shores of Europe. They don't have the regasification facilities. to handle all of the natty gas that's heading towards them, or the pipeline capacity.
Yeah.
So
So
it's
just because you have it doesn't mean you can use it.
exactly. So yeah, it's great, man. Prices are really high over there, but you can't get your product in through the door.
Yeah, yeah. No, that's. I think fingers crossed. We all pray that they don't have an extreme harsh winter this year. So 10-year Treasury is back above 4%. When you look at the 30-year, and I kind of bumped up the credit score this time, $400,000 house, 20% down. Again, this is state of Ohio. You could see the average 30-year fixed FHA, VA loans are all somewhere in this 7.3. Obviously you can trend up to 7.5, 7.6. And so the headlines after CPI last week, this was CNN literally a week ago when CPI came out. Mortgage rates hit 20-year highs. And so then they did the mortgage payment calculator we've done in the past. 1 year ago at 3%, you're $1,000 more for the same house versus a year ago. This is all kind of out there to the masses now. And then when you look at CPI, get into inflation, we had CPI, PPI last week. PPI came out and the market got annihilated. CPI came out last week and it was kind of baked into the cake, and the market had that hard bounce last Thursday. So when we look at inflation reads month over month, these are the net gainers. So the idea is that for inflation to top out, these all have to stop appreciating month over month. And so I guess the one glimmer of hope, the one bright spot here outside of alcohol not changing, is fuel oil, gasoline were actually down, which is good. Used vehicles down. And you can see gas prices, percent change from a year ago. You're still up dramatically, but you're at least trending back to the downside. And so what you want to see now is this, you want to see the pullbacks in these other core items, food. You want to see food start to trend back down. And so then when we get into, we've talked about this, Mike, how we're exporting our inflation to foreign currencies, foreign countries via the exchange rate. And so this is inflation year over year. This is the net impact on foreign currencies where you're paying, if you're in Turkey, you're paying 32% more than you were a year ago. You look at some of these countries, Great Britain, the UK, they're paying 15% more year over year. Japan's paying 22% more. These are inflation numbers based upon our dollar policy, based upon that flight to quality from foreign currencies into the US dollar, whether it's by design or, the byproduct of just flight to quality. These are real numbers here. That this is, we are exporting our inflation everywhere else. And so, what does this mean? Consumer prices rising faster than wages. Here's your CPI, here's your wage growth. And I think this next chart really hits home. We've talked about if you're a salaried employee, well, what does this mean to you? Well, okay, wages are growing, great. Here's my wage growth. But when you adjust it for inflation, unless you're getting a pay increase to match inflation, your annual 3% cost of living adjustment, if you're a salaried employee, this is what it actually amounts to. This is what your salary, you've lost just under 5% this year in getting your 2-3% cost of inflation adjustments if you're a salaried employee. So, you're seeing inflation hurt people firsthand. Again, that can least afford it, where you've lost money this year from a wage standpoint. So the other big thing, because of this, Social Security is going to get its biggest annual boost in 2023. You're going to go up 8.7%, highest increase since 1982. So you're officially back into the 80s type inflation type, ramifications.
Get out the hairspray and parachute
Yeah.
pants.
Yeah, exactly. So kind of getting into housing now and building materials from an inflationary standpoint, rent component of CPI Annualized, it's up 10%. A year ago, you're up 7.2%. But again, it's still cheaper to rent versus own. So you continue to see the shift back into rentals, and landlords can take full advantage of this.
I
And
just
so,
saw this. I don't know what the properties were, but one REIT rental investment company bought 846 units for $313 million. I mean, they're essentially paying almost $400,000 per unit
wow.
for rentals. So that tells you where they think their return's coming.
Yeah, no, and I think, so this kind of, you're having, these are listings, so you can see the red line is 2022. So 7.9% of new listings or homes on the market are having to drop prices here, versus, 2 years ago, a year ago. If you want to sell a house, you're not just going to get your ask now. You're actually going to have to probably take a counter below what your initial ask price is to move it. And so then when you get into, again, this is PPI when it comes to residential construction, building materials. You can see, you're starting to trend down finally, which is a good thing. And then when you look at softwood lumber prices, the obvious one is that you've obviously pulled back now dramatically off of the all-time highs, off of the highs this spring. But when you start to look at other materials that go into building a home, steel prices are finally trending down, which is a very positive thing. But when you look at ready mix concrete, you actually increased 1.4% in September, 6 consecutive increase. It has risen 11.6% over the past year. So no signs that concrete prices are topping out, let alone going to pull back here. And then the same thing with gypsum board, gypsum. Again, you maybe are topping out here, but you're still increased 20. You're up 20% over the past year, and up 46% since January of 2020. So you'd like to see signs, and I don't have the asphalt one, but asphalt roofing is very similar here. You'd like to see signs that some of these other building materials are going to top out or are in the process of topping out. And then
It's interesting. I don't know enough about the other materials, but I just wonder why. Why is it? Why haven't they?
I think for the people that are listening, if you have any insight, pass it on. I know a lot of people watch this recorded where I've had, just people out of the, like an amazing amount of different people just reach out and how much they watch this show. So you might be not listening now, but if you watch this in the recording, then please just reach out to us and give us any insight on other building materials.
And my guess is it's going to probably be sticky because to get prices to go down, you need one of two things: demand to go down or supply to increase. Well,
yeah,
with 100% probability we're going into a recession, I can't believe that, USG is going to be thinking, wow, let's really ramp things up now. Let's open up a new plant. So it's, I think someone just put up there, possibly due to the lack of supply, due to the lack of workers. This is obviously going to be solved. High prices in these other materials will be solved by lack of demand because supply would have taken care of it already.
Yeah, and once you start to lower these prices, especially if you have stuff locked in, once you start lowering it for one person, you're going to have to just do it across the board. So that's the other issue is, I think once they do start to correct, you're probably going to see a bigger corrective move lower because you're going to see it just across the board at that point. Here's freight, transportation, truck transportation. So, you can see you're definitely starting to finally trend lower, but year to date, you're still up year to date. So we know that prices, especially when it comes to truck, are coming off, but you're still up year to date.
We're seeing prices definitely less than we saw this spring.
Okay, good.
So, that maybe that's just in the flatbed because I know flatbed was running really, really hot compared to van rates. So we're just seeing great, definite pullback in truck freight prices. from the spring.
Yeah, and I would think that's obviously going to continue. To what extent, we'll see how. I guess that'll be the telltale sign now. Will be how trucking is going into Christmas here in anticipation of Christmas. So the other big news today: home builder sentiment drops to half of what it was 6 months ago. And you can see this, and I know you posted this on LinkedIn as well, Mike.
Yeah, I have this
Um,
actually. I was going to share this one. Look at, you know what?
yeah,
You stole my thunder.
yeah. Well, I mean, it's you're trending back to kind of the pre-pandemic or pandemic type levels, and when you just take kind of a moving average here, boy, this moving average is going to start to roll over hard here, and you hope you get some kind of a bounce out of this, that we're getting too bearish here, but this is a pretty disheartening looking chart right now.
All right, moving on.
So the other thing, this was out today. Again, I highly recommend people followed Leonard, chief economist of Freddie Mac. He puts out awesome stuff. His interactive graphs don't do these static graphs justice. But when you again, real house price growth factored in for inflation is now negative and accelerating. So you can see. Okay, here's the pandemic. You've blown through pandemic lows, and now you're back into 2000. You're getting back into the 2011, 2012 type levels with housing growth.
Something that startles me on that chart, and I have not seen it before, is when I look at what those low points were, those are some pretty gloomy times. I mean, 2008.
Yeah.
And then you go back. What's the 1983?
Yep.
And then the early 90s, there was that little dip there. Like I remember those times. That they're pretty hairy.
Yeah. And so then part of this is new listings. Obviously, if you can't sell your house or you've got to go somewhere else, and interest rates obviously, but you can see new listings are actually down 16.6%. So it's not like you're getting.
Of course.
And I guess the one positive thing, versus here, is that you're not going to get all this excess inventory on the markets here. So the idea that you're just going to flood the market with excess inventory like you did in 2008, into this time period is unlikely to play out. Is unlikely to play out anytime soon. So again, that people still need to live somewhere.
Anyone that's bought a house in the last 5 years is sitting on a nice mortgage. There's probably unlikely that they'd be willing to move out of that mortgage.
Well, no, and that's the problem. I think I read that 85% plus of existing mortgages, and it might even be closer to 90% of existing mortgages have rates lower than today. So you're not going to refinance, and that's how badly do you want to move to basically buy a new home now and pretty much pay double probably what your existing mortgage is today.
But that actually bodes well for new home construction. I mean, if you can't buy an existing home.
Yeah. No, and again, I think we have the bearish tone, and rightfully so, but we're not going to go back to zero. We're not going back to 600,000 housing starts. Again, you're just used to this 1.5, 1.6, 1.7 metric, and you're just have to adjust reality back down probably to sub 1.4. Somewhere in that 1.4, 1.3 area lies the truth, at least for early next year, Q1, Q2 of next year. And so we'll find out tomorrow. We have starts and permits. The forecast for permits is 1.53 versus 1.54 last month. Starts are forecast at 1.475 versus last month at 1.57. So we'll see if starts fall back under 1.5, and we'll see if permits can hold that 1.5 area. And then getting into actual lumber now, seasonality wise, when you compare lumber versus the last 5 years, we all know that seasonally we bottom into the, typically into the 41st, 42nd week of the year. You're into that time frame right now. It's October 18th. So, are we bottoming here on a 3-year, 5-year average? Here we are, over the last, kind of 5 years, we've bottomed further along into Halloween, kind of into just before U.S. Thanksgiving. So, we're into that time frame when we do bottom out. So, the idea that the market can trade lower, maybe it trades higher, but seasonality wise, we know we're in that period where we bottom out, but bottom out to do what? And so weekly continuation basis, again, we're trying to break out of this defined channel here, and this is kind of the ultimate, I guess you would say, bull flag here. What kind of push can you get? And we talked about this to start. Here's the November daily chart.
Hey,
So
let's jump back to that other chart.
Yep.
Something I know I've keep beating the drum on exchange rates,
Mhm.
but you got to consider. Let's just say this is a bottom, and we're seeing it with two of the majors announcing curtailments in a region that is benefiting from a stronger dollar.
Right.
So I know we've discussed input costs have gone up for the mills, just like everyone. Inflation is across the board. So I find it to really, it's kind of compelling that prices are going up here in the face of horrible news and curtailments in the face of strong dollar.
So Mike, that's a great, and here's a daily chart. Let me, I look at, let me flip this to a weekly. So all this is front month lumber converted into Canadian dollars. And so the return to the mill in Canadian dollars, hang on 1 second here, just froze my system, equates to about a $700 return in Canadian dollars. So, again, same thing, you're kind of toward the low end, but that's something else to watch where the returns are still pretty decent converted into Canadian dollars here. And so then on the daily chart, we talked about this. We're trying to break out above the Bollinger Band high. That would go a long way in kind of getting back to a 62% retracement on the November chart here into that 100-day. But the one thing I will say is that why are we rallying here? It probably has less to do with demand. It's not demand driven. It's more supply constraint driven or the potential of supply constraint driven. So, market structure 101, supply constraint rallies can be short term in nature. They can be violent in nature, but they're not sustainable unless the underlying fundamentals, i.e. demand, can support those higher levels. So any big spike up in lumber futures, in my mind, and we'll kind of get into this with the CFTC numbers, if you're a producer, you sell all these spikes in futures, especially at a premium to physical cash. I mean, from a basis standpoint, and we can kind of get into the basis, futures is not your best buy. Futures is your best sell. Cash is still your best. Physical cash is still your best buy right now. So if you're planning ahead, you go buy the physical cash, and if you're nervous, then you can basis trade the cash with physical, you can sell futures against it. But wanting to buy futures, especially November, at this premium to physical cash, no, go buy the physical cash. It's significantly cheaper. Fraser came on today at 455. They're up $10. I think one of the other large mills is in the 459 area. So cash is still by far your better buy for anything that you're looking to buy over the next month to 5 weeks here. And so spread wise, we talked about the spread last week. A week ago, you were in the 4 over area. Fast forward, we've traded out to 1770 so far. And just so people know that the mini spread has traded out to 2290 yesterday. So you're getting a little bit better amplification on light volume in that mini. But we know, just kind of here's that spread out at 1770 already. This is, Mike and I beat this into people's heads or attempt to. It's critical you understand how spreads trade. Even if you don't trade them, if you were long January here versus November, market's gone up dramatically here. Okay, we've bottomed. well off the lows, you would have picked up an extra almost $50 a thousand, $45 a thousand by buying November at 23 under January and watching this spread go to 15 to 17 over versus buying January. So you might not trade the spreads as actual spreads, but at least understand market makeup and why spreads potentially one's a better buy, one's a better sell. You know, this is the perfect example.
If you want to be long the cheap one.
Yeah. So now, you know, that kind of, if I'm going to buy futures, it's going to be January, and we'll see that on the forward curve. But again, basis wise, cash is trading at a bigger discount to futures. From a curve standpoint, November at 510, January at 494. Jan actually traded back to 480 today. If I'm buying anything, it's January. If I'm going to sell something, I probably, and don't want it to be November, I'm just going to go out to March and pick up the extra, you know, with these Jan-March spreads in the negative 17 to negative 20 area. I'd rather buy Jan, sell March based upon this curve. And here's the, you know, you can see, again, you've got good, again, if there was liquidity, you have good sell opportunities in the back months of the new mini contract. And then, so from a basis standpoint, a week ago, November was in that, this was probably negative 40. Today, you're out to negative 70 plus. Here's January, negative 54. March, negative 74. So again, cash is your best buy, futures are your best sell. But if I'm going to buy futures, I probably would want to buy, just based upon the spread structure, I want to buy January. And so from an open interest standpoint, a week ago, we were at 29.30. You could see the differential, you know, basically 3 to 1 here, Nov to Jan. Fast forward to this week, you're basically 2 to 1 now. Open interest is down 26.05. So you're definitely flushing out some of the weak-handed funds, and you're also flushing out some of the basis or some of the forward type longs that were long November, take profits in November, come out of the November and go buy the physical cash. And so from an open interest standpoint, managed money, you know, weak-handed funds are getting washed out. You've got long profit taking here. Not much change from a producer standpoint. So again, best case scenario, and I had commentary out yesterday, it's the hope at higher strategy. Best case scenario is you get these guys to just outright short cover and they get replaced by these guys. Pure and simple. The producers have not been short this market. So you get that move to 530, 560 plus. These guys, you probably wash out a third. I think 2/3 of this gets rolled regardless, and they get replaced. Those shorts get replaced by commercial shorts, by the sawmills being able to sell at a substantial premium to physical cash.
So we got one quick question here. A guy's asking, should I buy all my lumber now or wait? And you know, everything points to you should buy now. The cash market is cheaper than futures. The futures is in you know, a backwardation, so the backward months are higher than the current month. And you're seeing some major producers curtail, which means they're not real excited about making lumber at these levels. So all in, I'd say upside versus downside risk, the upside risk is much higher than the downside risk.
Yeah, and I'm just looking at that. And the one thing I'll stress is, again, when we're talking about prices and futures and physical cash, these are spot market prices. And just because you see these prices here doesn't necessarily mean you're going to see it reflected at the Home Depot big box type level, at the home builder level, at the retail yard type level. If they're still working off of high inventory prices, there conceivably could be a 30 to 45 day lag in working out of those higher inventory costs. And then the other part of this is from an interest rate standpoint, you know, what's the potential of seeing interest rates pull back? I guess it's always a possibility, but the probability suggests that interest rates are going to stay here or potentially go higher. So waiting, you're not necessarily going to get better interest rates. than you're seeing today. And you have the potential of we talked about this last week, Mike, where I think the average 30-year historically is around 7.75%. So, you can go back to mean type price levels, which means you could still see interest rates move higher here. And I think Lawrence Yun of the chief economist for
Freddie Mac.
I'm sorry. No, I'm sorry. Let me. I don't want to butcher his name here. Not Leonard, but where was it here? Sorry, I'm giving everybody whiplash here.
It wasn't the Leonard guy?
No, it was Lawrence Yun. He's head chief economist of not NHAB.
Home Builders Association?
Yeah. No, I'm sorry. National Realtors Association. Basically, he put something out earlier this week where he put forth the premise that you could see rates. And again, I'm not advocate. I'm just saying it's out there where you could see rates spike higher by another two base, full handles, where you could see rates go from 7.25 to 9%. You could see them go to 9.5%, where it's not out of the realm of possibility based upon historical interest rate hikes. No, I'm sorry, Brett, not Robert Dietz. It was Lawrence. I'll see if I can find this, and I'll, if anybody wants it, I'll see if I can find it. It was on LinkedIn earlier this week.
All right.
So other than that, what else? There's not much change in the mini open interest. Again, this is just going to be that laborious move into next year. Car velocity increased, which is good. Canadian rail stats look good. Not so good in the US, where again, there is fear of another potential. The rail strike is not officially settled. 6 out of the 12 unions still have to officially accept what was proposed, and the earliest they would strike would be after Congress resumes after the November elections. So you're talking into the middle to third week of November if this isn't settled.
All right. So market structure, not much has really changed from the last few weeks. Market structure is still the same. Funds are short, industry's long, a lot of rolling going on in the markets. We seem to have hit levels that the mills are prepared to take supply off the market. It could be a little race to the bottom between supply and demand. As demand starts to slow, supply is just going to have to keep chasing it. But all in, we need to see, for us to see any substantial growth in the housing market, we need to see stabilization or a pullback in rates.
Yeah, no, and I think, again, it boils down to, Mike, to know your market structure. And a year ago when the market was bottoming, we still had very robust, lots of green shoots. Rates were still on that 3% area. There was a big backlog of existing business, all this new single family business out there. So if you're not going to have the demand component support higher highs, lower lows, lower highs, and it's going to be off of supply constraints, more shutdowns, then kind of use this structure where, again, cash is your cheapest buy, futures are your best sell. Don't chase strength in futures and overpay. Go buy physical cash if you need the wood. Cash is your best buy right now. And if you're nervous about owning it because you're not going to have takeaway until the spring, then you have the ability to at least basis trade now, where you have a premium in futures relative to cash. And then the other thing I'll add, as far as just kind of reading the lay of the land in BC, Canfor announced the extension of an existing I think it was their Prince George pulp mill, and I know as one of their existing pulp mills that's been down, they announced an extension of that shutdown. So when you look at the shutdowns coming in BC, it has less to do with actual returns. It has everything to do with log deck, ability to bill out logs, availability of logs and log decks, and that will be the determining factor in BC as far as less is more. You do not have the fiber basket that existed a year ago, 2 years ago to support all of these BC mills. So the announcement, from a very large sawmill that came out yesterday, you're going to see more and more of those announcements. In my opinion, there's at least 2 or 3 more permanent shutdown announcements that will come out of BC. The writing's on the wall because the log availability, the fiber, the availability to source fiber to support all these sawmills in BC just doesn't exist, and it will not exist. So you are sunsetting out a lot of these sawmills, or enough of these inefficient sawmills, where the bigs will basically determine, you take this region, we'll take this other region. And so it's not a question of if, it's just a question of when some of these other sawmills permanently go away in BC.
And they're building them down south. Get used to some
Well,
heavier
and
wood.
again, so the other part of this is, it has everything to do about return when you start to see the shutdowns come out of the east, when you start to see shutdowns in Alberta, in the US, in the south, that's where it has everything to do about break-even point and cost of production when you see the shutdowns materialize everywhere else. But coming out of BC, it has everything to do with log deck availability, more so than return, than their break-even or returns at this point.
All right. Thanks, Greg. We'll see everybody next Tuesday.
Yeah, I appreciate it, Mike. As always, thank you, everybody. If you have any questions, by all means, just let Mike and I know.
All right. Hang on, Greg.